In this video, I'm going to teach day trading for beginners and break down everything you need to know when it comes to day trading. So if you're brand new to day trading or you're someone more advanced looking for some real day trading strategies, I'll cover everything in this video step by step. My name is Charles Moon and I'm here to help you become a better trader. Let's dive in. All right, so as you can see on my chart here, and this is a chart, we're having a pretty decent day overall in terms of upside and downside opportunities, and that's really important. When the market moves, that's known as volatility, right? But sometimes the market can move and just move in one direction, and it's really straightforward. Now, that straightforwardness could be sustained over a long period of time or a short period of time. That generally means that the stock is trending in one direction. Now, when it's trending up, the predictability of the stock continuing higher is what we're trying to play. Same with if it's trending down, we're trying to play that predictability of the stock continuing to go lower. Now, we have the ability as a trader of profiting on both sides. Even the most restricted accounts could also short as well as go long. There's different ways of doing it. You could do it with stocks or you could do it with options. But another aspect that we need to realize is that it is risky business, that no matter what the time frame that we trade, not everything we're going to buy is going to go up at that moment, that there are some potential that it could work lower. News could come out, of course. There could be a scandal around the CEO, of course, of the company. There's a lot of factors that could play a role that could negatively affect or positively affect that stock price. So today, what we're going to focus on is more of the short-term thesis on how we could spot opportunities. It's lesser in regards to understanding fundamentals and more in regards to understanding technicals. And yes, some people assimilate, day trading with gambling, but truth of the matter is gambling if you don't know what you're doing. If you're trading on a whim, oh, I like Apple, I feel like it's going to go up, so I'm going to buy. That's not enough reason to put your money at risk. So when we look at it from a day trading standpoint, all we're looking for is pinpointable opportunities to find a timing effect of when we could enter the market and potentially profit in a very short period of time. So you could see now on my chart, these candlesticks, they're green on the way up and red on the way down, and we've seen some big fluctuations. And if you look at the totality of the price movement and where it currently is, it's not far from where we had actually opened during the trading day. Excuse me on that one. And in turn, if we actually see the totality of that price move, we see that we had opened here and we're currently here. It's not that big of a difference, but throughout the day, there's been big ebbs and flows and price movement. And right now we're looking at the Qs, which is the ETF of the NASDAQ. So what we saw here was the NASDAQ go from 291 to 292.80. So a $1.80 move took place here in about a 10-minute period. If you had on just 100 shares, that equated to $180 to the upside in a matter of 10 minutes. And that's really what we're trying to focus on. Key returns, good returns, without having to risk a ton of money. Now, a lot of people say, well, if you buy 100 shares and the stock is $100, you're risking all of that money. No, you're only risking it if you allow that stock to go all the way down to zero. You're not putting that money at risk. You're only risking the price of the stock movement. Right now, I'm speculating, if we were to talk about it very quickly, that the NASDAQ is going to rebound. And if it gets above this level, we should start seeing it work its way towards that next zone. And so throughout the video, we'll have this up and see. As you can see, it's already starting to rebound. And I'll highlight exactly why my thinking is that way. Now, I'll tell you right now, when we get above this price and that follow-up white line right here, that's kind of going to be that little catalyst to jump up. Now, first and foremost, one of the first things that I want to do when I do start trading is to kind of look at, maybe some of the news that's come out early on in the day. And this is important because the news could start off with several different things. Number one, we could see upgrades and downgrades for a stock. That's analysts speculating where stock prices could go up or down to in the near future. As well, the news could kind of give us guidance on how things may have traded overnight in overall markets. But these analyst upgrades and downgrades could give a booster for the stocks, and the important information that we see relative to maybe global macroeconomics could also affect our stock market for the day. Since we're trading short term, we're only looking for smaller moves versus the overall bigger picture, right? We're not trying to capture a 100-point move here. If a stock moves 5 points, I'll be more than happy to capture 1 to 2 of that move. If we take on the attitude that we got to buy at the very beginning of the move and then sell at the very top, you're going to find yourself struggling. You're going to find yourself holding on to stocks way too long. That's not the attitude here. If the stock is moving up, we're just trying to capture that short-term momentum. And again, it doesn't have to move much for us to make money. And if it does happen to move a lot and we happen to hold on, we could obviously maximize it the best we can and utilize our technicals and kind of know when to let it go. But, the overall effect is it's better than losing money. Anytime we could take money out of the markets as opposed to giving the markets our money, that's an important factor. We could also look at stocks like RETA, for example, RETA, which has been fairly active, both up and down, but not really trending. More importantly, they're up around 177% on FDA news. Now, the technicals here are showcasing that we should see reversals at this level here and reversals at this level here, which we have seen. And until it starts breaking out in a trend, we're really looking to be very short term, both up and down in the stock. Let's look at FSLR. FSLR had earnings yesterday, so they had strong fundamental news. As you could see early on, they started taking off. Well, from that point, that was at 185. We're now seeing the stock rise, and it's gotten as high as 196. So imagine seeing this opportunity and then being able to take advantage of it. Even if you just took advantage of it for short term, it would be easily a very profitable trade as long as you were looking to be a buyer. The trend was up in pre-market. The stock was up as well off of earnings. That was a catalyst for Wall Street and the rest of the market to get excited about this stock. And so far, it is up $25, a huge dynamic move for the day. $25. I mean, again, it'd be nice to capture all of it, folks, but as long as we capture some of it, that's all that matters. So technical analysis is going to play an extremely important role. In fact, the way that the market has kind of pivoted towards technical analysis is really the advent of electronic trading really picking up. Again, electronic trading is fairly new. It's still kind of in its infancy in regards to the history of stock trading. It's only been very prominent here since really maybe the late 90s, early 2000s. But it's more about in the last 8 to 10 years that, technical analysis and electronic trading has really gotten big. And in fact, it's the primary way to go. Now, if you see here, I have generally what would be kind of known as a fairly complex kind of texture towards day trading, but I don't want that to really kind of scare you away. So let me just save this as a set. And let's just say this is a YouTube set. So I'm just going to save it. And what I'm going to do is remove everything here and make it plain and simple. Now, you don't need technicals to say that this is very bullish, that this is trending up. Now, what we do need to understand is what a overall uptrend is and what an overall downtrend is. The uptrend thesis is higher highs and higher lows. What does it mean by that? It just means that the stock price continues to go higher than previous. That after it makes these highs, it starts pulling back, but eventually goes higher than it previously had. And the lows are when it starts coming down and picks itself up. And as long as that we start seeing that these lows and highs continue to go in this direction, a 45-degree angle up, you know that the market sentiment, that the market demand is on the buy side. And that if you were trying to sell the stock, meaning anticipate that it's going down, you're not having a good day. But if you're anticipating that the stock price is going to go up, you are definitely having a good day. So the number one thing that as a trader we want to do is to try and get on the correct side of the market as quickly and as often as possible. That's going to be important. Outside of technicals, we have the ability of using trading patterns as well. These are reoccurring patterns that happen pretty consistently. This is important to know as well because history likes to repeat itself. This means that ultimately the markets could do what's known as rinse, wash, and repeat, right? Every day we wake up, we take a shower, we're washing our hair. It's pretty much the same thing over and over again. That really applies significantly to the market environment. Rinse, wash, repeat. When we start seeing the consistency not being shown, aka the stock now is starting to make lower highs and lower lows, that's now saying that the market sentiment has changed on the stock and that the predictability is no longer up, but it might be down. So this is really important. Now, if I was to start the day again, right, we're looking at news, we're looking at where the markets are kind of focusing on certain stocks that may have a fundamental reason to move greater than they normally do. Maybe the market has a reason to go way up or way down for that day, and we want to be prepared. As a new trader to the environment, especially if you are day trading, right, I highly suggest to you folks to stick with somewhere between 3 to 5 stocks every day. Make it the same 3 to 5 stocks every single day. Some people prefer volatility and some people want to trade volatility with options. So stocks like Tesla could be really good. Stocks like Nvidia could be really good. Stocks like Meta could be really good. You could also look at the ETFs for the markets. The SPY, which is the ETF for the S&P 500. The QQQ, which is the ETF for the NASDAQ 100. And, if we just focus on these every day, we're going to notice that the trading patterns, the stock behavior is going to be more familiar, and we're going to be able to kind of tune in a lot quicker and a lot faster. This is going to be extremely important because if we could utilize this situation, then we have the opportunity of taking advantage of this pricing movement. With FSLR, when it started to scream up higher, the market was like, this is going to start going. And as you could see, it barely worked lower. It pretty much went straight up, and it made almost a $10 move to the upside just to this point. And then it finally really pulled back. And from this level here, in less than 30 minutes, it jumped $3. So again, if we're not trying to capture a huge move, but we're only trying to capture a small portion of the move. Imagine having 100 shares at this time and seeing it jump $3. $300 made, done for the day. Again, if we average $300 a day, that's $1,500 by the end of the week, and that's $6,000 at the end of the month. Now, if you have a $5,000 account, I would highly encourage you to start focusing on making $50 to $100 a day and just walking away. And you're like, that doesn't sound great. But if you look at the totality of everything, by the end of the month, you made $4,000. You basically almost doubled your account by the end of the month just by trading very quickly and getting out for the rest of the day. You may ask, well, that sounds great. Now, how do I do this? This is where we got to learn trading patterns and trading opportunities in the market environment. So one of the very first ones that I want to teach you here, folks, is utilizing trading patterns. If you want to buy low and sell high, one of the great reversal patterns that I could show you is what's known as a W formation. The W formation ended up happening here, and the Q spiked up very quickly. Now, you may not be able to trade the Qs, but I'm just giving this example because in my trading room earlier, I had pointed this out and people were able to take advantage of it on the rise up. Now, as you can see, the market was in a hard spill down. We made new lows for the day, and it really looked like we were going to beeline to the downside. But yet, it started to find that floor and reverse. One of the things that we need to notice is that when the market hits a bottom, and then the subsequent candlesticks do not get any lower, even by a penny, and they just start to hold above that level, their very likelihood of a rebound starts to increase greatly. It really comes to two factors here. It goes sideways or it goes up. If the stock cannot go any lower, meaning it doesn't even go lower by a penny, the two moves that will follow through will be the stock either going sideways or going up. Some of you may already know what a double bottom pattern is, but there's also something to be known as a higher low reversal. That's going to be important to understand, because if we look for this pattern, the W pattern, near the lows of the day, that is what's known as a trend reversal sign. So if I point out this low right here where that green arrow went, that low was at 290.89. As you can see, it jumped up here very quickly and came back down to those lows. And just so happened that this low right here, next to this second arrow that I'm about to hit, right next to that red candlestick, that just so happens to be the exact same low price. So, like I said, as long as it holds the low and does not even make a lower low by a penny, the idea is that it's either going to go sideways or go up. So as you can see, it started to go up here. What's really key in this situation is the actual formation of a W itself. Now, I'm just going to pull this back in so that you can get a better visual cue. But you could see that it started to drop and it rebounded and started to come down. And in fact, it was trying to make what's known as a lower high. Lower highs and lower lows are the foundation of a downtrend, meaning the stock price is going to go down. But as it got down to this level and it started to break higher, the moment that we should be looking for a buy is the moment that it gets above this mid peak of that W. As you could see, once it broke above that level, it was accelerated and made a strong move to the upside. From that moment, ladies and gentlemen, that was nearly a $1.20 to a $1.10 move. That took place in less than a 4-minute period. That was easy and straightforward if you want to know. Where should you buy? The second that it breaks, you want to buy right at that moment right here. Where should your stop be? It should be below where the second arrow is by 5 cents. Pretty straightforward, right? Buy on that break, stop below this low here by 5 cents. So in total here, your risk at that moment was probably a little less. It's around 75 cents. The idea was that it was going to this top edge of the box and then the high of the day. As you can see, we went to that top edge of the box and it started to roll over, and then it started to base, and now we're back up again. So as you could see, if we held on too long and didn't make any actionable offense, meaning we didn't take any profits, we actually would have ended up with a loss. The follow-through steps here are going to be really important. That's what's known as trade management, which we'll get up back into a little bit later on. But I wanted you to be very aware of this video right here. So guys, if you happen to like this content, I want you to comment below what you like about it and what we could help you with. But this actual trade setup is in our Prosper Trading library. So if you want more details about this trading setup, you could just search in our library and look for the W formation and why I feel this is a great trade setup. You could get more details on that in that video as well. But I just wanted to highlight this as a short-term opportunity that you could visually see without technicals getting involved. This is just one of multiple trading patterns that you could finally use and utilize to take advantage of. So now let me bring in the technicals here. And I want you to understand what the utility of these technicals are and the importance of these technicals. Now for me, right now, I am focusing on a day trading indicator. And again, this indicator is best for day traders, known as the VWAP, the volume weighted average price. Okay. Now this VWAP is basically 3 key lines here. Okay. 3 key lines. So if I just remove everything else here on the top side, you can see the VWAP is 3 lines. It's a pink line here, a gold line here, and a lighter gold line down here. Now, I want you to know something. The middle line is a bit of a sediment gauge. It could work as support and resistance. The upper line and the lower lines are what is known as potential reversal zones. So let's just take a look and exactly kind of understand what I mean by that. Notice that the Qs here touched this golden line and ended up reversing. Now it did touch it here, but it didn't immediately reverse. I want us to understand that it's not going to instantly reverse the stock, but it can. Ultimately, what we look for is a follow-up reversal sign or a basing pattern once we get to these levels. So now if you kind of take into context the trading reversal sign in relation to where it is from a technical standpoint, you're like, oh yeah, we are definitely due for a reversal. Notice how we came back down to that gold line as well, and we have started to work our way up. Now, ultimately, these reversal zones are exactly what it is, but it doesn't mean it's going to reverse on the spot. Just know that that's what these levels can provide. And as a day trader, we could utilize these as zones where we should look to take profits. The sediment gauge, which is the middle line, is probably the most important aspect. If we are above this level, we should be thinking aggressive bullish, meaning aggressively looking to buy. Below this level, we should be looking to be aggressive bearish, aggressively looking to sell. When we are above this level, we also want to be passive shorters. Just because the stock is above that sediment gauge does not mean we could be short. However, the recommendation is to short near the highs or the second standard deviation, meaning when it comes up to this reversal zone, if the stock is projected to reverse, why not take advantage of the down move? And that's the same thing if we are below the VWAP, folks, okay? Remember, we should be aggressive short, but passive buyers. Let's look at the lows, and why not take advantage of that reversal off the lows? Now, for me, the market getting above this VWAP and holding is a positive sign. But certainly, all it's doing right now is going sideways. So that's why we need to break free from this box, which has been outlined as resistance, right? We pointed out resistance here. It's resistance right now, meaning it's the cap on the price. It can't go up any higher. And we're looking for the breakout above this pricing level. Now, for those that don't know what resistance and support is, associate the word resistance with the word ceiling. Associate the word support with the word floor. Obviously, with the floor, we're not going to go any lower than the floor unless there's a hole in that floor and we fall through. Same thing with that ceiling. We're not going to go through that ceiling unless we break through that ceiling or there's a hole in that ceiling that we could jump through. This is in relation, effectively, a trading terminology. Resistance is a cap on the stock price. Support is a bottom on that stock price. If there's resistance and that's being showcased, it's the market's telling us that the stock won't go any higher above that price. Notice how this pricing range and the tops of those candles are the same as this price level right here. Notice that right now the floor is being centered around that yellow line. That floor was right here earlier and right here as well. We couldn't go below these levels, so we turned up. We can't go above that level, so we have turned down. Now, if we get above that level, that could lead to some pretty fast price movement up or down, because in all honesty, there are people that are playing these levels and trading them to the downside or to the upside. And in turn, if we get through those levels, those traders are going to have to exit. Now, those traders exiting are the disciplined ones. They know that the stock could go higher and continue higher, and they don't want to be subjected to that type of loss. So they're taking their small loser and walking away. In essence, as a short-term trader, that's what we're looking at. We're looking at the overall structure. We're looking at the context. We're looking at repeatable history here and utilizing that to understand market sentiment. This is important. What if I told you that you could short here down to this level and then make money? And then you could buy here and play it up to that level and make money. That's what traders are doing right now. It's being pretty evident that we are boxing and trading sideways. And until the market makes a move one direction or the other, we're probably going to remain in this range overall. So now we could see that the markets are starting to apply a lot of pressure on this yellow line. So if we start losing this level, the idea is that since that's what's holding up the stock price, and it sounds funny to say that this little yellow line is holding up the stock price, but it is true. These little lines may play a very prominent role, that we're going to work our way back down. Remember, there's a lot of open space here. There's nothing really to slow it down, quote unquote, from working its way back down here now. So this is extremely important to kind of understand in relation to how the context of everything is applied and what the potential outcomes can be. So you may be asking, what would I look for in terms of a short? So specifically, if we start breaking down, what I would look for is a breakdown and then a revisit of this low, of this yellow line, as it's making new lows. And if it starts now getting lower than previous, I am going to be entering upon this rejection with my stop right above that yellow line. The idea here is that all of a sudden this level, which has been acting as the floor, could turn into the ceiling pretty quickly. So you could start seeing that it's starting to come down. We're looking for it to come back and retest and for that breakdown. It's very similar to how we saw it right here. If you take a look back at this circle back here, it started to apply that pressure, and look at how it hit that level and then broke down. And from that moment, it led to a bigger spill. Now, whether it comes all the way down and gets below that level, or it hits this golden level and then starts to reverse, ultimately, this is a projectable outcome and looking at that opportunity. When I was talking about that eventual break and run, we were looking for that immediate rebound, and we didn't get it at all. So it's now showcasing that the buyers are starting to give up and the sellers are taking control. And it just shows that this line right here, which I'll highlight in a bit, is playing a more prominent role. It basically became a key factor when it really didn't seem like it was going to be a key factor. And that's the beauty of understanding pricing action, because that really wasn't too much of a factor here, but it certainly showcased that it was a factor here. And this is now the outcome, the follow through from that initial reaction. So what are we looking for? Well, number one, it's understanding how we should trade and utilize these tools. If you think about it, if you're walking, in your house and the floor collapses, all of a sudden you're down to the next lower floor, whether it's the basement or if in your second floor bedroom, down to the first floor living room and or kitchen. That's the same process and thought process when it comes to trading, because when a floor is being showcased and the stock market loses it, this is going to be a key factor. We're using the charts and processing the information and the follow-through reaction to tell us the story here. So when I said earlier, rinse, wash, repeat, again, it happened here, and now it's starting to happen once again. This is something that we need to give an idea on and really respect, because that's how the market has traded 2 times already and now trying to make it a third. If you didn't realize that, now you have an understanding of why this VWAP tool is important. Remember, above it is bullish sentiment, and anything following through is going to be very key. But if this bullish sentiment is very weak and there's no follow through, well, you could see that buyers are giving it up and now sellers are taking control. If sellers are taking control and we're below the VWAP and we reject and move lower, that's only confirming that selling weakness and that seller sentiment. And quite honestly, if we're going to trade, we want to trade with the sellers again versus going against them, right? If millions and billions of dollars are going short, what is our, 10,000, 20,000, 50,000 going to do in relation to that market sentiment? So this is an important aspect. And again, it could become a, possibly decent trading opportunity. Respectfully, the volume is something that we also need to be very aware of, because that tells us how active the market environment can be. Now, as you can see, the volume is at the lowest of the day. It tells us there's not many participants relative to the market activity we saw earlier. That tells me that the likelihood of follow through is not going to be very high. However, the potential can be as the volume is starting to pick up. How do I know the volume is starting to pick up? So if you look very closely here, the previous 3 candles, the volume traded here. Now we're trading up here. So it tells us that the trading environment, the volume is starting to pick up. There could be that possible outcome of follow through here to the downside. Where should we look? Again, it makes sense that if this has been the reversal point, we could see the markets come down to this low and then start to work its way back up. That's been the sentiment that we have seen so far today. And that's where we now have an understanding of how we should trade based on the cause, right? The cause is this reaction, the ceiling being more prominent. The effect is now that ceiling prominence is leading to the floor breaking as well. And the outcome is pretty predictable. Without much to slow it down, no other real technicals in play, that it could start working its way down. So ultimately, it becomes a trade idea, our risk values, whether it's up here or right above that level, and a totality of potential profits. Shocker, we're working lower. The cause and effect, the structure and the outline, this all plays an extremely prominent role. Now, I'm not patting myself on the back yet. This isn't that big of a move. But I just want you to understand why we were looking this way and how you can start recognizing these opportunities. Now, as we get progressively throughout this video here, and now we're already pretty long into this video, you may see this outcome really come to fulfillment. And in that case, then you have an understanding of how you can outline one simple trade simply just watching this VWAP. Now, it's not going to be perfect and exact every single time, but I'm just trying to give you the very bare bones understanding of how to read this information properly and then utilize this information properly. The utility of using the VWAP is structure. It's structured from trading opportunities, such as a break of the VWAP to the downside, a reversal buy off the lows, or a reversal sell off the highs. It also will give us an understanding of where our profit targets could be. We play it to the lows. We look to take profits here at the VWAP and potentially finally exiting at the very highs if it got all the way to that level. If we took profits here and we're looking to see more outcome and we see this start taking place, guess what? Now maybe we need to exit in full because we know that the outcome could be all the way back to where we came in. That would be a shame, guys, that if you bought here and it made this entire move up and it comes all the way back down, you have nothing to show for it besides a break-even trade. That's the last thing that we want to do. Remember, as a day trader, we're looking to capture short-term price movements, right? Short-term price movements. And all we're looking for is to be on the right side of that market during that time. We're not looking for the whole schmagegi, guys. We're looking for a small portion of that move. Keep that in mind, folks. The day that you start picking the lows and selling at the exact highs, I want you to come back and then start teaching me. Now, truth be told, that is not something that the professional traders, people that have long sustained success do. And then again, if people talk about, I knew this was the bottom and I knew this was exact top on every single trade that they take, question them. Tell them to prove it to you, because truth of the matter is we really don't know. We could buy near the lows and sell near the highs. But ultimately, if that whole move, folks, was there, we're only trying to capture a portion of it. The moves tend to come in threes, right? We call them the leg, the body, and the head. The leg of the move, the body of the move, and then the head of the move. If we were talking about it to the upside, probably the best of the best, but most notably it's generally the bankers, the institutions, the floor traders. They're the ones that are buying at the feet or the leg of the move. The most consistent profitable traders are actually buying at the body of the move and looking to capitalize on the body of the move, the midpoint of the move. The retail traders, those that don't know, those that trade with emotions, that trade with FOMO, will buy at the head. And usually when you buy at the head, that's the moment that we start seeing it work down. Now, just keep that as well in terms of when you are starting to buy your trade. If we're chasing after these moves and we're constantly buying at the tippy top and then seeing it roll over, we got to know that the timing of our entries, which we had talked about earlier in this video, is way off. We need to focus on improving our timing aspect. People don't have problems buying stocks. That's not where I see people struggle. I see people struggling once they get in the stock. The usage of the technicals just don't provide information in terms of context for our entry, but as well with our trade management. So I'm going to also now start introducing more of my technicals, guys, okay? So let me remove these, bring back all my technicals, and start breaking them down. Now, one utility that you could use is a trailing stop. Now, this may sound funny, but the trailing stop could be a key component. Number one, if you buy in at those lows and you put in a trailing stop, well, ultimately the stop is going to move up if that stock is moving higher. And more importantly, it doesn't allow you to be greedy because it'll kick you out of your trade if we start seeing a reversal like this. So if you're struggling with holding on to stocks too long and you're more than happy to walk away with some money, right? Because some money is better than losing any money, then utilizing a trailing stop is going to be important. I actually use an indicator called the ATR trailing stop, which has helped to kind of keep you on the right side of the market, but can be used in terms of risk management. Now, if I pull it up to a quicker time frame, a 1 minute chart, notice that after we reversed on the lows, the dots went from pink to blue. Number one, when the dots are pink, it's telling you you should look to be a short seller. When the dots are blue, it's telling you you should look to be a buyer. For a day trader, I try to not trail my stops on the 3 minute chart but on a 1-minute chart, which is what I'm using here. But I was giving you a visual representation on a 3-minute chart. As you could see, we had seen that stop flip. And if you bought in at those lows, you could see how we're holding on those levels and trying to bounce. But the ATR trailing stop was just below that price. Well, as it started breaking down, notice how we have transitioned from blue to pink. Well, if we bought right back here and we got stopped out right over here, well, that stop is above our entry. We'd be walking away profitable no matter what. Now, even if this thing comes all the way back up to like 295, for example, who cares? People start, really, they take the wrong mentality. Be like, oh my God, I shouldn't have let go of that trade. I had it right. You know what, ladies and gentlemen, you start taking on that attitude and then you start holding on to things too long. And the next time around, when you should have exited, you're going to hold too long and it's going to bite you in the tail. Respectfully, the laws of averages are saying when you get kicked out, that's a good thing. And if it does work up higher, guess what? Traders trade. That means there's another trade setting up. Focus on the next opportunity. Focus on the next money-making venture. Don't harp about what could have been. If you guys ever watched the show Married with Children, Al Bundy used to always talk about how great of a high school quarterback he was. That doesn't matter. That was back in the day, guys and gals. Focus on the now. Focus on your next money-making opportunity. And if you've made the money that you'd be happy with, $100 a day, $200 a day, guess what? Your day's done anyways. Walk away, come back tomorrow. For some reason, people feel like if they trade early, they have to be here all day long. And usually, they get themselves into trouble more than they actually make more money. Do me a favor. Get in the habit of walking away profitable every day. You'll soon be way more comfortable getting in and getting out and going on with the rest of your day. I mean, if you golf, guess what? Early tee times. You got things to do. I don't know. Go mow the lawn, run your errands, get your car fixed, whatever you got to do. You now have that time to do it, right? If you don't want to lose your job, maybe you need to focus on your job as well, right? And just focus on trading in the first hour of the day. This is going to be extremely important. Now, another thing that we need to keep in an extremely mindful aspect is trading in correlation with the broad markets. Now, what I'm going to do here is give you a side-by-side look of NVIDIA. NVIDIA right now, is starting to find a ceiling at a very critical pricing range. Let me get my chart up here. And I'll show you exactly where we're finding that resistance, guys. Shockingly, it's at that little yellow line we had talked about. Now, mind you, we were just looking at the NASDAQ, and the NASDAQ was above that yellow line and started working lower. So think about the trading environment. NVIDIA is tied pretty strongly to the NASDAQ. I believe they're a top 5 weighting on the NASDAQ. They're probably a top 10 weighting in the S&P 500. So when the market moves, NVIDIA could absolutely help move the markets up or down even lower, but more importantly, will be affected by the market movement. Well, if you think about that collapse and that roll and how I talked about you should be looking at a short, well, seeing NVIDIA rejecting at the ceiling. Remember, if that's the ceiling, you can't go any higher. That turned into a great trading opportunity as well. It's the same thesis and thought process that we were looking at in the Qs. And now that you see the markets going down, well, stocks tend to be sympathetic with it. So if you look at your trading environment and we see the markets are going lower and you are looking at the stock and you want to short it, meaning you're betting that the price is going down, well, boom. You see the markets breaking their floor. You see the stock at a ceiling. 2 + 2, ladies and gentlemen, means that NVIDIA is an easy short that was available. So that short materialized right around 228.30. In a short period of time, NVIDIA got down to 226.85. So a $1.50 move in a short period of time. Again, 100 shares, that's $150. 200 shares, that's $300. If you had 3 contracts, that was $150. That's 3 deltas, and we'll get that into it in a little bit. But understanding the trading environment is really important. If we're buying and the market keeps going down, it is going to be very difficult for you to find success in that market environment. And in fact, that's at a point where you may have been expecting to take a small loss, but because the market kept spilling, the stock is now going relatively lower. Your small loss is now turning into a bigger loss, and now is starting to compound. And now it's starting to become that rolling stone where it's gathering no moss, and that $100 loss is turning into a $300 loss, turning into a $500 loss. And next thing you know, you're down $1,000. We don't want that to be a outcome. Sometimes cutting your losses at $100 and looking after the fact and knowing that your $100 loss could have been a $500 loss, in actuality, should be viewed as a winner. You saved yourself $400. That's $400 more you have left to allocate towards the next trade. Now, whether it goes all the way back down, of course, that's going to be dependent on the overall markets and whether they work lower. But it's not a surprise that it stopped cold at that level. When the markets moved down, NVIDIA ended up moving down. Let's take a quick look here at our markets. Still working on lower. Remember what I talked about, guys, when we looked at, right? And what the idea and the thesis is, it's still working on down. Now, in terms of what we should be looking at, I talked about that W reversal and that buy entry where your risk is. I talked about that VWAP recapture. It didn't really get to that level, but it did start breaking down and where your stop is. These are 2 easy to find opportunities that you can look for. Now, what other examples can there be? Well, let's look at FSLR. We're now starting to see it break down and reverse at the highs of the day. This is finally that first moment where we could see the actual break. This is an important price right here. Why? Because, well, if it loses that level, it's probably going to work down to where it can find a floor, down to that projectable level, pricing level down there. So how should we trade this? Well, we could look for that break and hold and that reversal down as well, but I don't really have a trade. That's more speculative in my opinion. A real good sign to look for where FSLR may be struggling to gain gains and really kind of give us that key visual sign that we're going to work down is by seeing it rally, getting up near that pricing level, and then start working down again. That will tell us that basically the ceiling may be in. You could see that this technical indicator, the linear regression, is already acting as key resistance. And in that factor, we could start seeing that knockback play a prominent role. Of course, it looks like the market may try and work that back up, and that's absolutely fine. They're trying to defend that higher low and bring it back up, right? That's been the nature of the beast overall. But now if we start seeing it break down, it's starting to tell us a different story. A, it should tell us that maybe this isn't a good dip to buy, and B, that we should be looking back here. But C as well, if we get back to that level and reject, we know that buyers may be exhausted and that we could look for that reversal play on the upside. Just like we would look for that W formation, folks, we could look for that M formation as well. M as in Mike, M as in Mary. It's kind of the opposite of exactly what the W is, but that would be a key sign for a reversal to the downside. Again, folks, if you happen to like what you've heard, and this is at least helping you shape your possible start into day trading, do us a favor, comment down below, let us know, subscribe, hit that notification bell so that you can get a lot more content from us. And don't forget, obviously this is a lot of work, and if you don't want to do that work every single morning, every single week in looking for stocks, you could click on that cheat sheet And we'll send out that information for you on what I'm looking at and what some of us here at Prosper Trading will be looking at as well. And that could actually give you a lot of time saved and give you a bit of a shortcut as you approach the markets on a daily basis. That's going to be extremely important here. And also, as I have mentioned, that W formation video, outlining that W formation video is also the M formation video. Now, again, notice how this stock is now starting to rebound. This isn't science, folks. This is just really historic, reoccurring ideas that happen on a daily basis. It's not like I knew exactly that it was going to bounce. I just knew that the market may reference this price. Now we're seeing that reference. Now we could be possibly setting ourselves up for the next trade, whether we want to be a buyer to back to the highs or we see a rally back and look for a roll back to the lows. Let's take a quick look at Tesla here. As you can see, Tesla was trying to gain ground, but they're now starting to become very weak. Look at where they're starting to get trapped up from. So you can see how they're hitting this floor here. If they get below that pink line, I'm expecting them to work all the way back down, shockingly, to that orange level where, just like we were finding resistance, the ceiling in FSLR, we're starting to find the floor here in Tesla. Just keep an eye on this price level here. Now you can see that Tesla is starting to break down and getting a little bit weaker. Again, if we look down, the volume overall has been pretty uninspiring. So we can't expect too big of a move. But ultimately, that outcome, that follow through, that idea is becoming more prominent. We just need to keep an eye on these factors as traders. And these two smaller examples, guys, are easily just kind of straightforward, and hopefully it makes a lot of sense even to those that are brand new. As you can see, we talked about the NASDAQ earlier, the Qs breaking down when we were right here as soon as it spilled through that level, and I was talking about it working its way down, and as you can see, it's worked its way down. And again, it's not like we could predict the future, but we understand our outcomes, and that's such a key component to being a trader. It's not about predictability. It's about recognizing the opportunity and taking on that opportunity to our advantage. And again, we don't need our money in the markets, all day long for multiple days, for multiple weeks for us to get a return. We could do it very quickly by smartly anticipating and recognizing what the market is telling us. And if we could do that properly day in and day out, like I said, it's a good way for us to sit here as traders to be able to potentially print up money on a daily basis. All right, guys, so let's take a look at another example of a stock that has done really well in pre-market, but is starting to work lower. CRM. So there's a saying, what goes up fast comes down fast. CRM was up over $25 today. And so, one of the things that I was looking at was, how is it going to perform within the first 5 minutes of the day? So that's a very key, aspect, because the first 5 to 10 minutes of the day, the markets basically will tell us what direction it wants to move in terms of either the broad general markets or the stocks, or both. And you could see that CRM had started at this level and initially started breaking down. So as soon as they followed through within the first 5 minutes to the downside, I was speculating it was going to work lower. Now, we certainly don't want to be chasing after the lows, but in some instances, this would have been a good opportunity for that chase. But we had talked about the VWAP and the structure and the context of it. And remember, when stocks are underneath the VWAP, we want to be aggressive bearish. So it does lead to the idea of playing into breakouts on immediate range extension down. It also makes a lot of sense in fading the rallies. I have other indicators on this chart right now that I didn't really talk about, the guppy in itself. But you can see as well, when stocks are bullish, the green layers, I'll move this out of the way, the green layers of the guppy will be above the purple layers. Now, whatever the colors may be and how it's preset, it can be orange over red. Whatever the lighter shaded colors are will generally be on top if it's bullish and on the bottom or below if it's bearish. And you can see that we went from being bullish, meaning the green being above the purple, to quickly switching over after the open. And so everything is indicating that we're working our way down. I also discussed this ATR trailing stop. Now, I haven't discussed much about it, but I will talk about what the usage of this indicator will be. Again, when we want to look for aggressive trades, we can look for the immediate spills, but they're generally not, a great idea, even at the open, to hold for too long, because we could always see the stock pivot if it comes to, key levels and rebound. So what I'd like to look for is reversals back to a price range of interest, which is the VWAP. And as you can see, we have stalled and worked our way down. We have also seen CRM trying to reverse up. They were trying to create that W formation that I've seen, but I've highlighted. But if you recall, it didn't break that midpoint. That's the trigger point. So as it failed here, all it did was tell me that there's a lot of suppression. And sure enough, there was great moments to position yourself here and here, and both had led to really good outcomes. Very easy pullbacks. Again, we're not looking for the totality of the move, but if we could get, $1 to $2 on these moves without really much sweat, it's really just pointing out the fact that we can really just pinpoint moments where the market will kind of turn on a stock both up and down, and utilize these moments to take actionable opportunities, aka trades. So how would I be defining this? Well, ultimately, if I'm using the VWAP as kind of that threshold gauge on market sentiment, I would be really interested in taking the short at that range and having my stop just above. It doesn't have to be much. I would only recommend around 5 cents, no more than 10 cents above that particular pricing level. And the projectability, of course, is back down to this gold line. Again, look at how many times it's touched that gold line and has bounced back shortly after. So that would be a easy earmarked target to the downside. And again, what are the indications telling me? Well, the guppy has turned down. The lighter colors are below, right? They're below the purple lines right here. This is now pink instead of blue, and I'll explain that in just a second. And we're trading underneath the volume weighted average price, the VWAP, or that sentiment threshold. Remember, above we're thinking aggressive bullish, below we're thinking aggressive bearish. We're passive bullish on the lows, and we're passive bearish at the highs. Thus, again, this mentality, especially if you're disciplined, which is the key component here, being disciplined, could offer up a lot of opportunities if you're patient enough, and they're high probability opportunities. It is a process to kind of try and learn, this information, but the totality of the information tells a story. And that's the whole component here. Letting the charts tell us a story and letting the information provide our speculation. We don't want to guess here. Again, certainly I can't predict the future. No one else can as well. But we could really swing those odds in our favor to make a very smart, decisive decision. It also is important that we remain patient for our opportunities and for our range, and also be disciplined enough to not chase after it in case it doesn't get there, but it starts moving like we speculate. The problem is that when you're not patient and you're not disciplined, it leads you to chasing after opportunities or thinking that you're going to miss out on this opportunity, and then you get smacked in the face. So even if you are familiar with technicals, at least that latter portion of the aspect that I just talked about here is something that you should truly concentrate on if you are struggling trading with technicals. Now, again, when this information is provided, it is important for us to understand the information that is being related to us. Number one, the information that's basically being provided is the price action. It's the money coming in and coming out into the stock, and that's important, right? Money is king in the markets. No matter what, whatever side has more money, the buyers or the sellers, whoever has even just a penny more is ultimately always going to win. That is just the laws of the markets, and that's important to watch out for. And number two, of course, we may want a stock to do something, but that doesn't necessarily mean it's going to do exactly what we want. Don't forget, it is up to us to move relative to what the market is doing and not to try and outthink the market. That's really important. Now, there may be moments as well that we may pinpoint a range where we could see that reversal, but I promise you we're not the only ones if it does actually happen to reverse at those pricing levels. It's telling you the market was watching that level, both on the sell side and on the buy side. If we're looking for a specific price range for the stock to pivot, and it pivots at that level, not only buyers or sellers are coming into that moment, but buyers and sellers are also exiting out of their trade as well, because they are collectively looking at that price range as a reference point. So if you ever see where stocks make new highs and immediately start rolling back down, you're like, why isn't it going higher? It just made new highs. Ultimately, it was people that was buying low. And when we made those new highs, they were taking profits off the table. That is the traditional sense. So you know when stocks start immediately extending, whether it's up or down, at those new highs or lows, it tells you that that move is dynamic. For one, either sellers or buyers are getting stopped out, which is helping that cascade or that breakout to the upside. And number two, ultimately, we are seeing traders also piling in. So those moments become very one-sided. And those moments that become very one-sided end up leading to very fast range extensions. Maybe a stock is trading from the highs to the lows back and forth all day long, and then they make these new lows, and then the move to the downside is almost as much as the entire totality of the move for the actual trading day. So Amazon is a prime example of this. If you take a look here, Amazon has kind of been going back and forth all day long. Look at this box, right? So if you look in the shaded box, you could just see exactly where all the highs and the lows have been outlined. Well, I just probably need to draw that a little bit better. But you could see right from pre-market trading, as soon as the break of that lows took place, well, if I highlight the entire move of the day with that red line, right to that moment, and then I highlight the move on that breakout from those levels to the lows, you can see it's virtually the same. And, you know, we're talking about instead of waiting all day for a big dynamic move, this is Amazon. This isn't the biggest of moves. But we could see that taking place once we start seeing stocks break free and immediately start to extend. And that's an important aspect to understand. Where can breakouts take place on a chart? Well, it's generally either at the highs or at the lows. We don't see breakouts in the midpoint of the range, because if we're trading in the mid of a range and we're not trading within the trend, this is obviously not in the trend, it becomes a coin flip. 50% chance it goes up, 50% chance it goes down. So when we recognize this, especially on the establishment early on, when we're not trading at these extreme levels, meaning the extreme lows and the extreme highs, we're really setting ourselves up for a potential coin flip trade. Now, you could see that we have been very responsive at the second standard deviation here on the downside, right? And to the upside. And as you can see, it started to lose their levels. And while we could anticipate it's going to bounce, usually after a tested support level breaks, there's usually that fallout. The fallout, once again, are buyers stop getting hit, those that were anticipating the rebound, and the sellers immediately jumping in, trying to capture a breakout play from a specific range. This is a very key factor to kind of keep an eye on here, because, again, the market is telling us the direction. If we're not breaking out and making new highs, or we're not breaking down and making new lows, Again, remember, it's either going to go sideways or go up, or it's going to go sideways and go down, depending on where we're trading. And in this instance, buyers were expecting it to hold the lows to either go sideways or go back up. And once we lost that level, there was no reason for those buyers to be in. Once sellers recognized that we're making new lows, sellers understood that there is a potential breakout opportunity here. And that's how, at that moment, the market became one-sided. Now, it's going to be a little bit more difficult to try and hunt these all day long. But this is something to keep in mind if you are watching a specific stock and it starts setting up like this, and then all of a sudden it starts breaking either north or south. This is where you could start anticipating the breakouts. Remember, stocks on general may look very different when we go from ticker to ticker, so not all stocks will trade the same. It's really up to us to be adaptive to how the market is trading that stock. And ultimately, when certain things take place, it is up to us as traders to recognize that and then, of course, trade in accordance. But that doesn't happen, folks, unless we have the knowledge to know exactly what to do in these moments. And that's why we're providing this content. Again, if you happen to like this content, we're going to provide a lot more. Don't forget to subscribe and click on for the notifications and comment below if there's other trade setups or other things that you may have questions on. You know, I'm here to help. And of course, that's what our whole company is here to do, to help traders, you know, really achieve the goals that they have when they're trading in the market environment, to you know, help those that have struggled or to help those that are very brand new to trading. And I hope this information helps. And again, I'm not asking people to put in, you know, maybe 5-6 hours a day in studying this information like us coaches may do at Prosper Trading. And if you don't want to do that as well, we have that checklist. Don't forget to click on that button down below and get our checklist for free so that we can provide that information for you. You know, names like CRM that made big dynamic moves as well. And certainly these are important factors. Now, we just talked about that breakout play. And notice how in that instance with that breakout, we're also kind of going from blue to pink. Now, these dots are important. Again, if you actually go through our library, I talk about the ATR trailing stop and how this is the most important trading indicator and probably the best indicator I've ever worked with, a trailing stop. But if you see how it transitions, it's telling you what kind of bias you should be. If it's blue, we should be thinking biased up. If it's pink and above the market price, we should be thinking biased down. And notice on that break right here that the stop had flipped, and notice the immediate outcome. And again, as we speak, we're still making new lows. So the judgment in this situation is not only kind of helped by the actual chart structure and that breakdown, but the technicals were also talking about the weighted opportunity here. Now, there was a bit of a false flag if you take a look where the green lines were below the pink lines. We had just talked about that. And ultimately, all we've done is trade in a box. So there's somewhat of conflicting indicators here, but, you know, the indicators wouldn't be conflicting if we ended up breaking up, at least for that ETR term. And all this did on this break was help confirm what everything was being presented in terms of rejection at the highs, more pressure on the lows, the breakout, which is indicating that there could be a bear run, confirmed by that pink dots flipping over, and of course already showcased by the green lines being below the purple lines. This is important because now we have that qualifier to go after that breakout at that moment. And certainly, if you had done it, you would have been rewarded. Let's take a look at a stock like FSLR today as well. FSLR has been on a pretty decent run, but if you notice here, folks, we got up to the highs of the day. And notice that the tag on the left was the high of the day, and right here, we did not make a new high. So this was a great instance where I would have said, this is where you should be looking as a passive seller. a lower high, a double top. And if I actually draw a line here right at 199.35, you'll notice that this level here only came up to 199.22, and it immediately started to work lower. It went from a green candle to red candle. Green is bullish, red is bearish. And look, it went from this level all the way down to the lows. If you guys are wondering, that was a $7 drop in about 20 minutes. So remember, we're not looking to, capture the entire move, but in this instance, it was very possible. Remember, we always say if we're going to go passive, that we want to be very attentive of what the stock does at the VWAP, that gold line right here. And as you can see, it ended up breaking down below, ended up getting trapped down and sent cratering to new lows of the day. It's a beautiful sign. And as they have tried to recover, notice that they failed and continue to get knocked back. It's very similar to what we had talked about with the Qs early on in this video, and now they're getting trapped and moved lower. So you're already seeing a lot of the things that I've talked about being showcased in stocks that are totally different than previous. This is the thing. It doesn't matter what the 3 letters or the 4 letters of the company are. What matters is that these are consistent, reoccurring patterns that happen day in and day out, no matter what the stock is, no matter what the company does, no matter what the sector is. This is both, applicable to both the top side, meaning the bull run, and the downside, meaning the bear run. As a day trader, we don't only just want to be pinholed to trading one side. That only leaves us with 50% of opportunities. And a lot of the times we'll find ourselves forcibly trying to make a trade work because we could only buy, or being overly aggressive in our pursuit for buys. And those could lead to some really, really difficult days. That's where we could see small losses overall really stack up, or some bad judgment plays really accelerate and lead to really big losses. And that's the whole thing. We didn't even have to take those trades, so we could have avoided those losses in general. Or we need to start thinking on both sides of the spectrum and make sure that we are on the correct side of the market. Now, you've heard me say that a lot throughout this video, and that's important. If we're not on the correct side, maybe we lost on that trade, the first question you should ask yourself is, why was I on the wrong side? That's something that one of my mentors had directly told me to do. If you didn't have success, okay, instead of blaming any other factors, the first question you should ask is, why was I on the wrong side of the market? And initially we'd be like, I have no idea, I don't know. But the more that we kind of study and look into this, the more we're going to understand exactly how this craft works. And the more that we could really kind of key in on those factors, the more we're going to realize when situations are going to be very favorable, meaning profitable for us, and when moments are going to be extremely risky or more likely not going to work out for us. So these are important factors, okay, that we could utilize, that we could keep in mind. And of course, I'm not expecting everybody to watch this video, however long it's going to be, and immediately go out and trade the following day and just, kick tail and make a ton of money. No. What I'm going to ask you is watch this video, review it, and after you think you know it, watch it again. And in fact, if you truly, truly respect and understand what we teach in these videos, I can't recommend it enough to just keep watching, literally until you could almost spit what I am saying verbatim. It is really important that you understand the concept, the context of day trading, and whether it's my methodology or others, more importantly, it's also to remain disciplined, to remain patient, and let the markets come to you for your trading opportunities. We don't have to win at an 80% scale, win-loss ratio to be profitable. Remember, we can win 50% of the time. Heck, we can win less than 50% of the time and still be extremely profitable. And for us to do that, we need to keep our losses small, and let the winners run. Now, if we're looking for small, fast reversal plays, these are always going to be our lowest risk, highest reward opportunities. As I pointed out here, if we were to look for that short, our stop should only be about 5 cents above that intraday high. As you can see, it's at 199.35. Well, I mean, it's simple math, guys. That means our stop should be at 199.40, just above that high. So imagine you were able to get in right here at, let's say, 199.10. You came up to 199.22 and you start seeing it knock back and you're like, okay, I'm going to jump in. Let's even say at 199 even. So now you have 40 cents of risk exposure. If it doesn't work out, you get stopped out at 40 cents. You lose 40 cents a share. What was our downside target initially? It was back to this VWAP range right here. So right here was at 97.30, 197.30. So in that instance, you were risking 40 cents to make $1.70, or a little over 4-to-1 reward to risk ratio. And in turn, as it broke all the way down, guys and gals, and look at how far it came down. The low here was at 192.68. So let's just say it came down to 193. Now in this situation, you put yourself in a position where you risked 40 cents and made $6. It was that easy. Look at how fast it broke down. Look at how big this range extension was, meaning how far the price had moved once it lost this layer. Look at how big that move was. Very dynamic. So these are important moments that we could recognize to attack the market. And we're not attacking with 25 points for a day trade of risk. We're attacking with very minimal risk exposure with great potential for reward. Even if you just scalped it for $1, okay, that still puts you at a 2-to-1, 2.5-to-1 reward to risk ratio. So if we're doing that every single time, right? We're losing 40 cents, making $1. Losing 40 cents, making $1. Losing 40 cents, making $1. So let's say you take 10 trades, okay? 5 of them are losses, right? 5 of them are losses, at 40 cents. Holy cow, that doesn't look great. Let me do that. At 40 cents here, okay? And 5 of them are winners for $1. Well, if you look at it in this light here, guys and gals, right? We're losing about $200 in this situation. When we win, we're making $500 in this situation. So, as a trader that's winning on a 50% win-loss ratio, you lost 5 and won 5, you are net profit $300. Now you just keep doing it over and 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 over again. Again, one trade a day, $100 a day, you know, that adds up pretty quick, folks. That really does. It's $500 a day. I'm sorry, not $500. $500 a week, right? $2,000 at the end of the month, $24,000 at the end of the year. $200 a day, $48,000 a year. So on and so forth. And all we have to do is just be patient for a moment, attack, and if we do it properly, great. We could actually win at an 80% clip and do exceptionally well. But if we are active throughout the day, all we need to do is be around 50%. In fact, in this scale, folks, we could be at 40% and still make money. That's extremely important to recognize here. That if we put ourselves in a position of success, we will be successful. All in all, when it comes down to this, we just need to remember that we're processing information that the chart is telling us, and we're utilizing that information to help speculate in the markets. Now, when you piece this all together, it's nothing different than anything that we have in respect to our livelihood, right? Whether it's something that we have learned through college and education, right? We didn't learn calculus right away. We had to learn simple, basic mathematics before we got to that point, right? Chemists aren't sitting here trying to, make these complex recipes. They're learning, right, the periodic table initially. Engineers aren't sitting here ready to build out buildings right away. They're trying to learn that A plus B will equal C. That's the whole aspect, folks. We're starting from the ground floor and learning to work our way up. Just take your time, review this video, learn one thing step by step. It all adds up. Preparation is key, patience is key, discipline is key, and when everything lines up, folks, the only thing is left for us is to click that button. Now, folks, if you happen to like what we had heard today, do us a favor, please comment below. Let us know that you liked it. Let us know that you want this more information. If you have some questions, maybe questions that you're struggling with in regards to trading, or you just certain context of how to approach certain trade setups, let us know. We'll be more than happy to help out. Subscribe and click on that notification bell. Don't forget, we have a lot of information below. Click on that link underneath to get our checklist. And until next time, peace and love, everybody.